Welcome back. Another question that I get fairly often is, why do stocks go up? Why do stock prices increase? How do we make money in stock? All kind of the same question. Now, there's some simple answers, what you might even call folklore or related, but they don't get us very far. So people say, well, more buyers than sellers. You could argue that's a bit of a dysfunctional market because there's always the same number of buyers and sellers at any price. So what I want to do is walk through a way of thinking about, why do stock prices go up? Another way of asking the question is, how do we make money in stocks? I want to start with three basic questions. And then when we get to the third question, we will have answered the big question. So the first question I like to ask this a lot, particularly in class, is why buy stocks? Why would you buy a stock? Either collectively or individually, why would you buy them? Lots of interesting answers. Things like own part of a business. I think that's true. To collect dividends. Some stocks pay dividends, but most don't. Other ways to do it. I think it's really quite simple. In fact, I think the answer is shockingly simple: to make money. So why would you buy a stock or a collection of stock? To make money. It's not about diversification. It's not about owning part of a business. Those are all aspects of making money. But we buy stocks for the very simple goal: to make money. All right. Next question, I think, is also pretty straightforward. How do we make money in stocks? The most common answer I get is buy low, sell high, which is true, but it misses the question. That's just your hope, is to buy low and sell high. But how do you make money in stocks? Again, very simple. They go up. All right, so why do we buy a stock? To make money. How do we make money? They go up. The stock price goes up. All right, terrific. We're doing well. Third question is now the main question that we want to talk about. Why do stocks go up? And for that, we need a longer explanation. In some respects, I struggled with this question for a very long time. But then again, you'll see in a minute that Ben Graham claims he never resolved this question. So I don't feel so bad that it took me a long time to answer the question. If one of the greats, perhaps the greatest of all time, felt that the question couldn't be answered. Let's see if we can do better than Graham, and maybe faster than it took me personally. All right, so the common question I get, why do stocks go up, is more demand than supply. And I guess technically that's true. It just doesn't get us very far, because I would just follow that up with, why is there more demand? Supply for most stocks tend to be generally fixed, sort of. Even that's a bit of a slippery slope. The full number of shares outstanding tends not to change much over time for a lot of companies, and rarely does it change over a short period of time. They can issue more shares, of course, do an offering of some kind, issue options to employees, things like that. But more demand than supply doesn't get us very far. All right, how about now the proverbial more buyers than sellers? Again, since every transaction is an exchange, in terms of the number of shares, there's always the same number of buyers as there is sellers. So that doesn't get us very far. I think what people mean to say is that at a given price, there is more demand for the stock than there is currently sellers of the stock at that price. So an easy way to think about it then would be, well, more buyers than sellers at a price. The buyers are forced to pay a higher, or at least offer a higher price to entice the sellers to sell. As the price goes up, buyers are forced to pay a higher price. Then ultimately, over time, you would expect that some sellers would come out of the woods and say, wow, at that price, higher price, I'm willing to sell. And now all of a sudden, then buyers and sellers are matched up, and there's an equal number of buyers and sellers. So you could argue, we could be done, I guess, with the lecture by just saying, well, at any given price, there's more buyers than sellers. Because the sellers want to buy, they're forced to offer a higher price. But it just leads to the next question, which is, why are the buyers willing to pay a higher price? So I think we need to get behind this question a bit more. All right, now to Graham. So in 1955, March of 1955, the U.S. Congress called together a committee on banking and currency, And one subdivision, one aspect of that was to look at the stock market. And this is a very small snippet between the chairman and Ben Graham. Now, I'm going to put this in context in a couple of ways. Ben Graham had started investing in the 1920s. And by the end of the 1920s, he was worth $1 million. Nominal, not by our standards, but nominal. And then, of course, we all know that in 1929, very devastating crash came. And by 1932, Graham had lost about 70% of the value of his portfolio. He then fought hard, and by 1937, he was back to even, and he went back to be a very successful investor. In 1934, he published his famous book, Security Analysis, with David Dodd. And then in 1949, he published the first edition of The Intelligent Investor. And as many of you might know, Buffett read the book when it came out and was so excited by the book that he ended up at Columbia Business School, which is kind of cool. So by 1955, Ben Graham is certainly one of the most famous investors in the country, and he is called forth to testify at this committee meeting. And this is just a little bit of the snippet, but it's my favorite. I'll read parts of it because I think it's fun. The chairman asks one other question, and then I will desist. I love the language. It's very gentlemanly. We could use some of that these days. So he said to Graham, when you find a special situation, now Graham had talked about his investment style was to look for special situations. That's what Graham called them. So the chairman said, when you find a special situation and you decide, just for illustration, that you can buy it for 10 and it's worth 20, and you take a position, and then you cannot realize it until a lot of other people decide it's worth 30. I've always been intrigued by that question. When he says you cannot realize it, I think the chairman means you won't get your profit, that is the $20, unless a lot of other people decide it's worth 30. Again, we could sort of talk about that question. Why do other people feel it has to be worth 30 to pay 20? Well, you're not going to pay 20 if you think it's worth 20. So Graham thinks it's worth 20, it's trading at 10, he buys it at 10, but he needs over time other investors to come along and say, hey, wait a minute, I think this is actually worth 30, more than what Graham thinks it's worth, so I'm willing to pay 20 because I think it's worth 30. And then he goes on, the chairman goes on to say, how is that process brought about? By advertising or what happened? And this answers what I love. Mr. Graham, Ben Graham responds, that is one of the mysteries of our business, and it's a mystery to me as well as to everybody else. I think that's just hilarious. And then Graham goes on to say, we know from experience that eventually the market catches up with value, price catches up with value. It realizes it one way or another. All right, so why did they call this hearing in 1955? And the reason is because the 10 years from 1945, the end of World War II, to 1955, the stock market was up 250% over a 10-year period. And I think there are a lot of people concerned that this was similar to the stock move in the 1920s, where although the stock went down a bit in the early 20s, it then roared up, and it was ultimately up 300 and I think about 25% for the decade. So I think there were people in Washington, and you can even imagine what the cover of Barron's magazine was. It's going to be a repeat of the 1930s. We all know what happened in 1929, stock market crash. At the time, there were a lot of people that thought the stock market crashing led to the Depression. Obviously, we've learned since then that that was not a causality, but a result of the Depression. And the fear, I think, is that, holy smokes, we could be headed to another stock market crash and then maybe another depression. I think that's why Congress called this. And we know in the 1920s, stock went up a lot. And then in the 1930s, it went down even more. So you can understand their concern. All right, so now here's that question again. I want to walk through this. All right, so when the chairman refers to the stock price, or 10, that's really price, and 20 is value. That's Graham's set of value. The chairman then says other people decide it must be worth 30. That's sort of the key structure of the question. And then Graham says, this is that mystery. It's a mystery to me as well as everybody else. All right, now what's interesting, 1956 forward, the market actually continued to go until 1968. It didn't peak until 1969. So the concerns were misplaced. A big difference in the 1950s, 1960s was the huge increase in economic activity coming out of World War II. That's what really drove the stock market. It wasn't just euphoria. It wasn't just animal spirits. It was actually economic progress. All right. Now, it's important to understand that stock recommendations, when we talk about stocks, they're actually narratives. We as humans are wired to like stories. And so all stock recommendations are effectively stories. No one goes on to on NBC and says, the moderator will say, hey, what do you say, where do you get your value from, or what's your sense of value? And the response is my DCF using a 5-year explicit forecast and a 3% terminal growth rate and an 8.5% discount rate says the value of this. No one does that. And they may have modeled it that way and then use that as a way to determine value. But what they do is they tell stories. They find a narrative, and that's the key to all of this. I think one of the keys to all of it. So stocks is narratives. So the estimate of intrinsic value is essentially a narrative, and it can be modeled as a DCF. And I think that's an important important frame to think about it. So price, market price, is the consensus of all narratives. That's effectively what it is. All right, now we can use the DCF to value the asset. Or in this case, the stock price. So the value of any asset using a DCF is the present value of all future cash flows discounted back for time and uncertainty, or we often say time and risk, but it's not, time and uncertainty. Now, the value of a company, since it's an asset, should also be the present value of future cash flows discounted back for time and uncertainty. We're modeling the value using a DCF. Now, the challenge we have is it's an estimate of value. We don't know what the future cash flows are. We may have a pretty good idea of the discount rate that we're going to use, but we don't know what those future cash flows are. So what we're trying to do is come up with an estimate. So stock price is effectively an estimate of future cash flows. So stock price is an estimate of future cash flows. All right. Therefore, price is a consensus estimate of that future value. It's a consensus estimate of all of those future cash flows. So now it's fairly easy to begin to answer the initial question. Changes in the stock price are equal to changes in investor expectation. Now, investor expectation about what? Generally about future cash flows. So changes in stock price are changes in expectations, investor expectations about future free cash flow, which is modeled on the two biggest drivers for that is overall profitability and growth. Those are going to be your two biggest drivers. Those are themes we'll come back to a lot. Current level of profitability drives your earnings power value, and growth drives what I like to refer to as market implied value of growth, which I've touched on a bit in prior videos. All right, so stock prices change because consensus expectations about future cash flow change. It's pretty simple. So consensus expectations change because new narratives emerge, new ways to tell the story. That's the key. So now we're back to our three questions. Why buy stocks? To make money. How do we make money in stocks? They go up. Why do stocks go up? Investor expectations about the future increase. It's that simple. In future videos, I'm going to talk more about where those changes in expectations come from. But we've now answered the three questions, which gets us to our primary question. Why do stock prices go up? Investor expectations about the future increase. New narratives emerge about the future. New stories emerge about the future. And what essentially gets priced in is either increased profitability or increased growth for the future expectations. All right, so there's our three questions. We've answered the big question, which is pretty cool, which is the point of this video. All right, thank you very much for watching.